Hey everybody, it's Ken McElroy. We're here on Real Estate Strategies, and I'm here with my friend Eric Freeman. Hey Eric.
Hey Ken, happy to be here.
Yes, Eric. Eric's with Fleischman, and they are the company that does most of our tax returns. So for those of you that know, we have a lot of property, a lot of self-storage and office and multifamily and land and new development, et cetera, et cetera, et cetera. And we meet with Eric every quarter to go over our tax strategies. And we do right around 100 tax returns.
Yeah, that's about right.
So our company does about 100 tax returns every year. And of course, right before this, I thank you for bringing a lot more tax returns up here today.
You're welcome. I just wanted you to be tired when you're signing them.
So this is a great opportunity for you guys because, taxes are confusing, even to Ross and I. I mean, there's a lot of law changes and there's lots of things that happen and there's lots of things you can do legally to save on tax. So the first question we're going to talk to you guys about is, around ownership structure. So, I know there's a lot of confusion around this, and so Eric, what do you feel is the best ownership structure for the real estate investor? What are some pros and cons?
Yeah, that's a great question. So, there's a couple considerations first, which are one, what are your plans with investing in the real estate? Are you investing for buy and hold as a rental? Are you investing as a flip? Are you a developer? So there's all kinds of considerations. But I guess I'll tackle one of the most common, which is a buy and hold type strategy. Maybe not hold forever, but how you hold for 5 years, whatever it may be. Generally, you're going to want to use some kind of a legal entity, not hold it in your name, in your individual name, and there's a couple of reasons for that. One is more of a legal issue and trying to get as much protection as you can. And then the second issue is dealing with whether you're investing with partners or whether you're investing alone. So one of the most common structures is using limited liability companies. You can, if you're investing on your own, generally using a limited liability company doesn't affect your taxes. So it's just kind of an easy protector. Just put it in an LLC and it's reported the same as if you owned it individually, but you get that extra liability protection. And
so how does that work? Like, let's say, well, first of all, for those of you guys may know, I actually don't own anything in my name, personal name. Every single thing I have is in some kind of an ownership structure for asset protection reasons. But, here's what happens. I find a lot of times people go out and they buy, let's say they buy a duplex and, it's $500,000 and they buy it in their name, they get the credit in their name, they get the loan in their name and all that. What can they do at this point?
Well, so most banks, you're going to run into an issue when you're getting a conventional loan that they're not going to want to lend to an LLC, especially one that doesn't have a track record.
Right.
So a lot of times you're kind of forced to do it in your own name at first. A lot of people, after you get the initial loan and buy the house, or the duplex, put in your name, then maybe a year later you might transfer it to an LLC that you own completely. The bank may not necessarily like that because a lot of times they have what's called a due on sale clause in there, which essentially says something to the effect of, if you transfer the property, we're going to call the loan due. But generally, that's not going to happen if you're just transferring it to something that is still effectively you. So by doing that, you are in a way helping get some asset protection, but the loan is generally still going to be in your individual name.
Right. So this is not about trying to transfer the loan, into an LLC. This is about asset protection, but also, let's say you call it ABC Investments. Now you can open up a bank account in ABC Investments, right?
Right.
And then the tenants write a check to ABC Investments and everything flows into this account. It's called the EIN number, right? The employee
identification number.
Yeah, EIN, employer identification number, and you have to give that to the bank. They can open a bank account for you, and then what you do is you have your tenants pay into that, and you can pay all your expenses through there. And then all of a sudden now you have this tax return for this standalone entity, right?
Right. Yeah, there's a lot of benefits to it. One, it comes off more professional to tenants. Two, it's cleaner when you're reporting your taxes because now when you get to the end of the year, you've got a bank statement that has all your income, all your expenses in one place. You're not having to sort through whatever your various credit cards and whatnot. It's simplified. And at the end of the day, as important as taxes are, also knowing what your net amount is number one.
Yeah, I tell you, it just makes things a lot more simple. If you guys think about it, like we all have a lot going on. We have cars and we have our own homes and we go on vacations and there's all these things that we do and dinners and things like that. If you can just put all the stuff in a separate LLC, in a separate bank account, run all your expenses and all your income through it, then you have a very clean accounting too, right?
Right.
Everything runs through there. The tax return's clean. And, it just makes a lot of things a lot easier, especially at the end of the year when you're trying to sort through all those papers.
Yeah.
Like it can be, and then you actually, what happens is if you're ever audited, it's even harder to prove. Right?
Right, exactly.
So that's why these entities are really, really important. So you talked about the LLC. Let's talk about the SCorp and the corporation because we used to do SCorps.
Right.
I've done some corporations, but there's very different ramifications on tax.
Right, exactly.
Right? So let's talk about those.
Yeah. So generally speaking, you're not going to use a C corporation for real estate. Now, it depends what you're doing, but most of the time you don't want to hold any real property in there. And the major reason is, one, it's difficult to get it in and out without paying tax. So say you want to transfer the ownership, you want to change it 5 years from now, or you want to add a partner or something like that, it's very difficult with a C Corp without some kind of tax ramification. The second reason is income generated from a C corporation does not get any type of preferential rates. So a lot of times when you sell real property, you're not paying at the same rate that you would your income from your job at an ordinary rate. You get what's called a capital gains rate when you sell. But a C corporation does not have capital gains rates. You're still paying at an ordinary rate. And then the third reason why you don't want to do it is because you end up paying double tax. So you not only pay tax at the C corporation for any income generated, but then when you take dollars out, you also pay what's called a dividend tax again. So your tax rate is much higher. You have less flexibility. So generally, you're not going to use a C corporation to hold real estate. An S corporation is similar in terms of you don't want to hold the real estate generally. It's more used as kind of an ancillary type entity. Maybe you want to use it. There's benefits to use it if you grow and you want to use it as a management type company. There are certain benefits you can get from that in terms of reducing self-employment tax, things like that, getting fringe benefits, which is basically just getting reimbursements for your car and auto that you're using, health insurance, things like that. So you're not actually holding real estate in it, but it's ancillary to your business. And then of course there's other there's other benefits that are probably get a little more complex when you start developing. S-corps can have
complicated. So how does somebody decide? It can be daunting. I know when we first came to you guys, 10 plus years ago, you actually unwound a lot of our LLCs and S-corps and put them into different things based on, different legal things we could do inside of those. In fact, I think we even have some C-corps. Yeah. I don't really understand all the reasons, but I know that but you do. It's so what could people do? What should they do? Because Ross and I just moved blindly as we bought stuff. And, the attorneys tell you kind of what to do, but then it's interesting. There's a very different conversation with an attorney than an accountant.
Right.
And I found, I'll tell you one thing that happened to me. I sold a business once, and my attorney negotiated it awesome, but then I ended up paying a lot of money in tax. And then at the end of the year, I brought it to my tax guy. Sorry, it wasn't you at that time.
So
and
am
he's
I.
like, hey, if you would have done it this way, I could have saved you 50 grand on tax. I'm like, are you kidding me? So what you guys need to know is that, there's, what your attorney says is not necessarily the best thing from a tax standpoint.
Right.
You actually need to have advice from both, right?
That's exactly right. I can't even tell you how many times that exact situation has happened. I think it's really important, one, educate yourself on the basics just so you understand the language from a legal and a tax perspective. You don't need to know everything. That's not your job. But definitely talk to both in advance and get ideas, because what's good for one is not good for the other all the time.
Yeah. So now, I know not all tax accountants are created equal, right? So how does somebody navigate through that? I get a lot, I've referred you a bunch of business over the years, and people come to me and they say, who do you use? But there's a lot of people that just do books, And so what are some of the questions people could ask, in order to find out whether or not, they're getting the right advice? Because I found a lot of time on one of the properties I bought, if you remember, we bought that property up in Sedona. The seller had a horrible tax accountant, and he had like a $2 million tax liability if he was going to sell the property. So we went and restructured his tax and his ownership structure so that he didn't have any tax on the sale. I did it for the seller, because I wanted to buy the property.
Right.
And this happens a lot, right? I mean, I bet you see a lot. What are some of the things that people can ask or do to make sure that they're getting a good firm?
Well, I think number one is someone that you get along with really well, because ideally you want to be able to reach out to them when you've got a transaction happening, and you want them to be able to give you the time to guide you through it. So I think that's number one. They can have all the knowledge in the world, but if they're not there to help you.
That's true, guys. We're on the phone with Eric. I bet you there's not a week that goes by there's not an email or a conversation with you, right?
Right. That's exactly
easily,
right.
Almost every week.
Yeah.
Yep.
So that's number one, I think. And then number two is it's really difficult if all you've got is a job. There's not a lot you can do in the tax world. But once you start owning real estate, having a business, there's just tons of options. So if you're going in and you want to kind of lay down what your situation is, and if you're getting ideas back, that's a good start. You don't want someone that's just saying, we'll take care of it.
Give me your stuff, and and here's your return, and don't forget to put a stamp on it.
Right, exactly.
Right. No, I've been there. It's interesting. Like you're always pushing back and saying the word depends. That's the word.
Your favorite
hey, Eric,
word.
what about this? Depends. Which is like a really long conversation, but that's what you want.
Yeah.
That's actually what I want.
Right.
I'm always plowing forward, and so is Ross. But then you always kind of bring it to a tax, level, which is really, really, really important if you guys are buying or developing or selling, because there's ways to do it. That legally that you can mitigate tax, right?
Right. And I think you bring up a good point, because that also reminds me why I say depends is because even though there's standards of how you generally do things in the tax world, just like everything else, everyone's situation is different. So it's a good sign if whoever you're working with is not just telling you what to do, but they're actually asking you things like, what are your plans with this investment? Do you have a time frame? What do you want to do with it? Who are your partners? What's your goal? Basically, what are your goals? And then from there, you can determine what the best plan of action is for your specific situation. If they're just telling you this, then they're in, the mode of just cranking out the same thing every day.
Right. So, right. The reason why we love Eric and Beach is because you basically challenge us. What are we doing this quarter? What are you buying? What are you selling? What are you refinancing? What has a cost seg on it or cost segregation? What are we doing for depreciation? What capital expenses are we, should we be doing? And we're all trying to mitigate tax. And so at the end of the year, which might surprise you guys, we'll sit down with Eric And he's already combed through all of our deals, and he's like, "I need you to spend money on these properties, right?
Right,
all the time. Like this is I mean, who doesn't want to hear that? But he's like, I need you to buy new fitness equipment, or buy a new golf cart, or buy a maintenance cart, or do this because there's all these reasons that you can take the losses. So we might have a lot of gains that we're trying to offset, and you can do it, if you're upgrading and continually doing things to the property. So if you guys are managing this through the year, then come March or June or July, these things should be in motion because you have to spend all the dollars in the year, right?
Right. Generally speaking, right. So, and I'll just add that a lot of times all the things that we're saying you should spend money on are things that you want to spend money on anyway in the business. It's about more timing. So buying new fitness equipment or golf cart or upgrading the units with countertops, whatever it is that you end up doing, hopefully are things that are increasing the value of the property or increasing your income. It's not that we're just saying spend money to reduce your tax,
that's
right?
a good point.
So I actually had a tenant, because I do some rental properties on the side, and he came to me, a potential tenant, and I was asking him about his business and everything, and he was doing some kind of martial arts on the side, and he goes, "Well, I'm looking to rent because I want to do this on the side and, generate some expenses to reduce my taxes." And I'm just looking at him like, wait, so your tax planning strategy is to spend all your money?
Yeah. Well, there's a lot of people that think that way. They're quick to say, "Oh, you can write that off." I'm like, what? What does that even, you don't even know what that means? Right. So I think what you brought up a really, really good point. So, all of our properties require capital needs. And, we have capital strategies, and hopefully you do too, on the roofs, on the parking lots, on the, on the interiors, and, on things that we're doing. And so if you can, if you're planning on doing something the next year and you can do it, 1 year earlier, these are things that you can do to reduce tax, right?
Right, exactly.
Yeah. And so that's what we're talking about here. And obviously if you can renovate or upgrade your place, you're going to probably get a little bit more rent. Hopefully, if it's certainly on the interior, so it all makes sense.
Yeah, and it's good to know a little bit in advance. This is one of those times where it's worthwhile maybe talking to your tax advisor first on what items you can actually expense that year versus items that are what we call capital expenditures. So there's a difference between items that you can just write off in the year that you spend the dollars versus items that are more long-term in nature. So if you're doing a major remodel of some sort, then sometimes those items have to be capitalized and what we call depreciated, which means you take a deduction over many years as determined by the IRS. So it's good to know in advance if you're expecting this deduction, well, is it one that I can actually deduct this year, or am I going to have to wait to get this deduction?
Right. Very, very good point. So I have one last thing. So we've talked about an LLC, an SCorp, and a CCorp. Why would anyone ever use a CCorp? Because it always gets this bad rap for double tax.
Right.
Can you just walk through that?
A lot of times, so in specific to the real estate business, it's one of those things that may be what I call an ancillary type entity. So you're generally not owning real estate to it, but maybe you're paying wages from it, something like that.
Okay.
So that can be one of the benefits. If you have enough income and you're getting management fees, maybe you're managing your own property, maybe you're managing other people's property. There's a certain way to use S-corps or C-corps to pay your wages and reduce things like self-employment or take other types of expenditure. So you're generally not trying to create income necessarily within the C-corp, but it's a way to pull out wages so that they're not
like the martial arts guy.
Right, exactly. Exactly.
All right, Eric. Hey, thank you again. This is great. Hopefully you guys enjoyed that. So make sure if you guys are setting up an ownership structure, one, you need to do it for asset protection, but also contact your tax consultant and find out exactly what entity you should be using. So thanks again.